Zone 6.
I'm Michael Zenga from Danvers, Massachusetts. That's a town whose band Mr. Buffett so generously sent to the Rose Bowl parade last year, so you're a very popular guy in my town. Good morning, Mr. Buffett and Mr. Munger. Mr. Buffett, I wanted to ask you this question last week when I ran into you after Gillette's annual meeting, but I choked. So now there's no pressure, here goes. In the years from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued, excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah, most smart people, unfortunately, in Wall Street figure that they can make a lot more money, a lot easier, just by one way or another, getting an override on other people's money or delivering services in some way that people. And the monetization of hope and greed, is a way to make a huge amount of money. And right now, it's just take hedge funds. I mean, I've had calls from a couple of friends in the last month that don't know anything about. investing money. They've been unsuccessful and everything else. And, you know, one of them called me the other day and said, well, I'm forming a small hedge fund, 125 million he was talking about. And, you know, like the thought that since it was only 125 million, maybe we ought to put in 10 million or something of the sort. I mean, if you looked at this fellow's Schedule D on his 1040 for the last 20 years, you know, you'd think he ought to be mowing lawns. But
Yeah.
but he may get his 125 million. I mean, you know, and it's just astounding to me how willing people are during a bull market just to toss money around because they think it's easy. And of course that's what they felt about internet stocks a few years ago. They'll think about something else next year too. But the biggest money made, you know, in Wall Street in recent years has not been made by great performance, but it's been made by great promotion, basically. Charlie, do you have anything?
Well, I would state it even more strongly. I think the current scene is obscene. I think there's too much mania. There's too much chasing after easy money. There's too much misleading sales material about investments. There's too much on the television emphasizing speculation in stocks.
Zone 7.
Robert Peyton from Chicago. The Honorable Warren Buffett and the Honorable Charlie Munger. I felt it would be appropriate to address you both in a manner that reflects the tremendous amount of value that the two of you have been instrumental in unleashing for your shareholders, your employees, and the good of society. The area that I'd like to inquire about is stock options. As you are aware and have written about in the past reports, companies have been taking advantage of and contributing to FASB's inadequate rules regarding stock options. In particular, the lack of having to expense them on the income statement and the lack of having to report them as a liability on the balance sheet. My question is, are either one of you doing anything to help FASB's current stance on the issue? If not, have either one of you ever considered establishing a, quote, real, end quote, independent body of accountants that would actually try to make companies produce accounting statements that reflect economic reality?
Charlie, I'll let you get the history on it.
Well, we don't like the accounting, which we've called corrupt, or at least I have. And I don't think that's too strong a word. I think it's corrupt to have false accounting because you like a certain outcome better than another. All that said, I don't think either of us spends a lot of time fighting with FASB or trying to create a better one. It's like splintering your lance against stone or something. You'd get a lot of back pressure from the butt of the lance, and we can't be expected to cure all the ills of the world.
We've written about it and talked about it. Obviously, you've picked up on it, and when it was an active issue, whenever it was, about 4 years ago or so, Senator Levin of Michigan was one of those who felt as we did, and of course FASB felt as we did. But the pressure was incredible that American business brought on Congress. They weren't getting. They tried to put pressure on FASB and they weren't getting a result. So they just said, well, we're not going to let FASB set the accounting rules. We'll have Congress set the accounting rules. And I thought that was a bad idea per se. But I thought in this but they got plenty of supporters. Got a huge number of supporters. I mean and at the time I compared it, I think there was a bill introduced in the Indiana legislature in the 1890s, I believe, and the bill was to change the value of the mathematical term pi to 3 even instead of 3.1415. And the legislator who introduced it said that it was too difficult for the school children of Indiana to work with this terribly long, unending term, and it would be so much easier if pi was just 3, and he thought that they ought to enact that. Well, I thought that was quite rational compared to what the Congress of the United States was going to do in telling people that since one of the arguments was it makes it very tough for startup companies if they have to expense this. Well, it makes it tough if they have to pay their electricity bill too. But I mean but those were the kind of arguments you got. And my memory is, Charlie is better on this than I am probably, but I think the accounting firms 40 years ago or 50 years ago were in accord with our position. But every client would put pressure on, and they don't want to report expenses. They particularly don't want to report expenses that are paid to them, and that can be huge, and that might prove obnoxious if recorded by conventional accounting, but if it's sort of lost in a table in the proxy statement, people don't pay much attention. So the only way it will get changed, we wrote about it, and I even talked to a few senators at the time. The only way it'll get changed is and this is the only way corporate governance problems generally will get changed, if 15 or 20 large institutional investors would band together in some way on this. But some of them have the same problem because they're getting paid extraordinary sums for doing something that is really not adding that much value. So they're not really inclined to call attention in many cases to what Charlie would refer to as obscenities in other people's compensation. So I think it's going to go on. I mean, it's a fascinating subject, but the institutional investors seem to focus very much on matters of form and not substance. I mean, you get a lot of they cluck a lot about little things that don't have anything to do with their economic return over time. Whereas on stock options, there's something that's terribly important. They're the ones that are paying the costs, and the costs are there whether they get recorded or not. But American management will not change its position on that voluntarily. Consultants will never change their position. They're getting paid to encourage people to look at other companies, and it just keeps ratcheting up. So I don't think you're going to see change unless institutional investors do it. And as I say, I get these questionnaires, about the composition of the board or a nominating committee. None of that makes any difference in terms of how a business performs. Got one form. It said they wanted a list of directors broken down by sex, and I said none that I know of. But it just is not germane. Charlie?
Yeah, right. Well, I can't top that one.
Zone 8, please.
Steve Casbell from Atlanta. My question concerns Gillette. Do you think their goal of trying to grow earnings at 15+% kind of got them into their current inventory problems at the trade? And as well, the Duracell acquisition, I know at the time neither one of you were the biggest fans of the deal. I just want to know how you feel about it now.
Well, I would say it's a mistake, and I've said it, I think it's a mistake for any company to predict 15% a year growth, but plenty of them do. For one thing, unless the U.S. economy grows at 15% a year, eventually any 15% number catches up with you. It doesn't make sense. Very, very few large companies can compound their earnings at 15%. It isn't going to happen. You can look at the Fortune 500, and if you want to pick 10 names on there that will compound their growth from other than some extraordinarily depressed year. I mean, if they had a year where they just broke even, so the number is practically zero. But if you pick any company on there that currently has record earnings, and you want to pick out 10 of them that over the next 20 years will average 15% or greater, I will bet you that more than half of your list will not make it. So I think it's a mistake, and as I said in the annual report, I think it leads people to stretch on accounting. I think it tends to make them change trade practices, and I'm not singling out Gillette in the least, but I can tell you that if you look at the companies that have done it, you will find plenty of examples of people that have made those sort of mistakes. And I think that in connection with Duracell. I mean, obviously Duracell has not turned out the way that the management of Gillette at the time hoped that it was going to do, and who the investment bankers who came in and made the presentations, those presentations would look pretty silly now. Charlie?
I think that kind of stuff happens all the time. It will continue to happen. It's just built into the system. I see more predictions of future earnings growth at a high rate, not less. I mean, a few people have sort of taken an abstinence pledge, but it's very few. It's what the analysts want to hear.
It's what the investor relations departments want the managements to say. It makes their life easier, but they don't have to be there 5 years from now or 10 years from now doing the same thing. If we predicted 15% from Berkshire, 15% means that, assuming the same multiples, I mean, that means, in 5 years, 200 billion, in 10 years, 400 billion, 15 years, 800 billion, trillion six in 20 years. And the values get to be crazy. And, if you have a business with a market value of 400 or 500 billion, and you've had a few of those not so long ago, just think of what it takes to deliver in the way of future cash at a 15% discount rate to justify that. If you've got a business that's delivering you no cash today and it's selling for $500 billion, to give you 15% on your money, it would have to be giving you $75 billion this year. But if it doesn't give you $75 billion this year, it has to be giving you $86.25 billion next year. And if it doesn't do it next year, it has to be giving you almost $100 billion in the third year. Those numbers are staggering. I mean, the implications involved in certain market valuations really, belong in Gulliver's Travels or something. But people take them very seriously. I mean, people were valuing businesses at $500 billion a year or a year and a half ago, and there's just almost no mathematical calculation you can make that would, if you demanded something like 15% on your money, there's almost no mathematical calculation you could make that could possibly lead you to justify those valuations. Charlie, you have any more?
Well, I said on another occasion that to some extent stocks sell like Rembrandts. They don't sell based on the value that people are going to get from looking at the picture. They sell based on the fact that Rembrandts have gone up in value in the past. And when you get that kind of valuation into stocks, some crazy things can happen. Bonds are way more rational because nobody can believe that a bond paying a fixed rate of modest interest can go to the sky. But with stocks, they behave partly like Rembrandts. And I said, suppose you filled every pension fund in America with nothing but Rembrandts. And of course, Rembrandts would keep going up and up as people bought more and more Rembrandts or pieces of Rembrandts at higher and higher prices. I said, wouldn't that create a hell of a mess after 20 years of buying Rembrandts? And to the extent that stock prices generally become sort of irrational, isn't it sort of like filling half the pension funds with Rembrandts? I think those are good questions.
Once it gets going, though, people have an enormous interest in pushing Rembrandts. I mean, it creates its own constituency. Zone 1.
Mr. Buffett, Mr. Munger, my name is Joe Schulman. I'm a shareholder from Oxford, Maryland. Thank you for a wonderful meeting. In order for Berkshire to have an opportunity to hopefully grow its earnings by about 15% per year, if we can do that, at least for the next few years, it's obvious that because of the redeployment of earnings and float, the existing businesses do not need to grow at 15%. At what rate would you expect the existing businesses to grow to achieve an aggregate rate close to what I'm describing? And what do you think the probability is of achieving that?
Yeah. Well, I think the probability of us achieving 15% growth in earnings over an extended period of years is so close to zero, it's not worth calculating. I mean, we'll do our best, and we have a lot of fun doing it. So it is not something where we have to come down and do things that are boring to us or anything of the sort. I mean, our inclination is to very much to do everything we can legitimately to add to Berkshire's earnings and things we can understand. But it can't happen over time. We will have years when we do it, and you're quite correct in pointing out we don't need to do it from the present businesses. We will add things all the time, any more than we needed to do it from the current business back in 1965 with the textile business. I mean, we have to improvise as we go along, and we will. And the businesses we have are good businesses in aggregate. They will do well. They won't do anything like 15% growth per annum, but we will take a good rate of progress from those businesses, and we will superimpose upon that acquisitions which will add to that. But we can't do 15 over a period of time, and nor incidentally do we think any large company in the United States is likely to do. There will be a couple that do it for a long period of time, but to predict which of the Fortune 500 will end up being the one or two or three would be very hard to do, and it won't be more than a couple out of 500. If you take large companies not working from a deflated base year, I think our method is a pretty good one. I mean, I think the idea of having a group of good businesses that throw off cash in aggregate in a big way, that themselves grow, that are run by terrific people, and then adding on to those, sometimes at a slow rate, but every now and then at a good clip, more businesses of the same kind, and not increasing the outstanding shares. I think that's about as good a business model as you can have for a company our size. But what it produces, we'll have to see. Charlie?
I certainly agree that the chances of this 15% per annum progress extrapolated way forward is virtually impossible. I think generally the shareholding class in America should reduce its expectations a lot.
Including the pension funds.
Yeah, including the pension funds, you bet. It's stupid the way people are extrapolating the past. Not slightly stupid, massively stupid.
And this is a message, incidentally, if you think about it. I mean, nobody has any interest in saying this, a financial interest in saying it, whereas people have all kinds of financial interests in saying just the opposite. I mean, you do not get an information flow if you listen to the financial world or read the financial press. You do not get an information flow that is balanced in any way in terms of looking at the problem, because the money is in believing something different, and money is what it's what causes people to become prominent, or it flows from becoming prominent in the investment world in terms of whether you go on television shows or whether you manage money or trying to attract it through funds or whatever it may be. I don't think if you were an actuarial consultant and you insisted that the companies that you gave your actuarial report to use a 6% investment rate, I don't think you'd have a client. So it's almost impossible for the advisors, in effect, in my view, to be intellectually honest on it. Don't you think so, Charlie?
Yeah, there is a very smart investment advisor in my town, and he said that years ago some risk arbitrage firm would tell his clients, we know how to make 15% per annum year in and year out. And he said, years ago everybody said that's impossible. He says, now in this climate they say, so what? Who's interested in a lousy 15%?
And it was easier in the earlier climate,
yes,
obviously, because the money hadn't been attracted into it.
Generally speaking, there's more felicity to be gained from reducing expectations than in any other way. It is simply crazy for this group to have very high expectations. Moderate expectations will do fine for all of us.
Okay, we'll take one more before we break for lunch. We'll go to number 2.
Good morning. My name is Ken Goldberg from Sharon, Massachusetts. A few questions ago, you mentioned the company's investment in USG. I was wondering how you got comfortable with that as an investment in light of the asbestos exposure. Do you view the company, the stock, as cheap enough and the asbestos exposure as manageable enough over time so that the investment is justified? Or do you view it as, in a worst-case scenario, if the subsidiary with asbestos exposure blows up, the rest of the solid businesses are insulated from that and are alone worth the price of the investment?
Let me answer that. I don't think we want to comment.
Yeah, it's 0.1% of Berkshire, roughly. I mean, but as Charlie says, that gets too close to giving stock advice. But I will tell you, their asbestos problems are serious, and they would be the first to tell you that. So let's take a break for lunch. We'll be back here in half an hour or thereabouts, and look forward to seeing you then. Thanks. Okay. I hope you've all had a cholesterol-free lunch, and we will move on. And when we stop, we were about to go to zone 3.
Hi, my name is Jason Tank from Traverse City, Michigan. I've got one kind of quick question that I'm sure you can answer relatively quickly if you're not interested. I know that Walter Scott's on the board of directors, and he's also on the board of directors of a company called Level 3 Communications that is in an industry that's, well, there's been a lot of change happening, and stock prices have been plummeting. I wonder if you've probably spoken to him at great length about the economics of that business, and have you ever expressed any interest in that business, especially at the prices today? That's the first question. The second question is, if you look at Berkshire Hathaway as a portfolio of, you've got wholly owned subsidiaries as operating businesses, marketable securities, common stocks, and bonds. If you strip out, and if my premise is wrong, just please tell me. If you strip out the leverage effect of the cost of the float being nearly zero or negative throughout the years, if you look at the portfolio minus that leverage piece, how fast do you think your book value would have grown over the last 30 plus years? Are we talking about 5 or 6% due to just the leverage piece on the insurance float?
I don't think it would run as much as 5 or 6 percentage points, but the float has been very useful to us. And actually, I've never made the calculation, so you could well be correct that if it was 5 or 6 points, that would be a quarter of our book value gain over the years being attributable to insurance float. And I think that's probably maybe on the high side, but you can't make it. We don't look at insurance float 100% the same as we would look at equity, but we've looked at it a good bit. It's largely tantamount to equity because we've had so much equity we could afford to do it that way. So you'll have to make that calculation yourself. We think insurance float has been a huge asset to Berkshire. We think it'll continue to be a huge asset, and we look for every way possible to increase the amount of low-cost float. On a small scale, we added U.S. liability last year, an excess surplus lines carrier based in Philadelphia, and so far that's working out extremely well. I've got a terrific guy running it, and in a small way we add float there. I just looked at the first quarter on it, and we had a significant underwriting profit, and we had float added, and that's the best of all worlds. So we'll keep working on it, and it will add. It's a big asset that Berkshire has that a great many companies, virtually no other company has it to the degree that we have, that also invests in other businesses and uses it as a source of money to invest in other businesses. Question about level 3, I obviously can't answer. I can tell you that you have two enormously smart and high-grade guys in Walter Scott and Jim Crow in that business, but it's not a business I know a lot about, and if I did, I wouldn't talk about it. Charlie?
I cannot talk just as well as you can.
Not always. Okay, section 4.
John Gollop from Kansas City. I have a follow-up question to your comments about how financial statements can be distorted by making over-optimistic assumptions about returns for the pension portfolio. If you believe accounting statements, as published in annual reports, returns on equity for U.S. businesses are amazingly high, higher than in Europe, higher than they've been historically, higher than Japan. Are these highs, do you think, completely attributable to accounting shenanigans, or are there any fundamental reasons in addition that might make returns in the U.S. higher than in Europe or higher than they've been historically?
Well, I would say that they certainly, to the extent that American returns have been higher than those around the world, at least in developed countries, I would say that they are not solely due at all to accounting shenanigans. I think that the absence of honest accounting for option costs has been a factor, but American business has done very well, excluding any accounting activities that Charlie and I might differ with. I'm no expert on exactly what returns have been around the world in developed countries, but my impression definitely is that American business is well above average for the developed world in terms of profitability, and I don't have the answers as to why that's occurred. I think that American business and I think the whole American system has reflected more of a meritocracy than exists in many countries, and I think that a meritocracy works best. I think that mobility between classes, which is the flip side of a meritocracy, does tend to get the Jack Welches into positions of where they run a General Electric or an Andy Grove or an Intel, or go up with Sam Walton at Walmart. I think if you'd taken those same individuals and dropped them down in most countries, they would have done very well, but I don't think they would have done quite as well as here. And I think that what they have done well has spilled over in a big way to benefit the American economy. So I would not lay it all on the accounting shenanigans. And the pension funds accounting, that applies very heavily at some companies, and of course most newer companies don't have pensions. Companies that have started in the last 20 or 30 years are much more inclined to have various kinds of profit sharing or 401ks. The older industries that took on pensions, spurred to a great degree, I think, by World War II, when you got excess profits taxes that ran to 90%, and there was a huge incentive to start pension plans and fund them heavily, because the government, in effect, was funding 90% of your pension obligation. So there was a great boom period in the inauguration of pension funds, and of course that meant steel and auto and all of those big industries of that time. Charlie?
Yeah, it isn't so much accounting shenanigans as it is deliberate financial practice. Take General Electric. There's been a deliberate increase in financial leverage, which was made possible by the wonderful and deserved reputation. There's been a deliberate increase in repurchase of stock, which General Electric has done even when they're paying huge multiples of book value. That sort of thing does wonders for returns on equity, as reported, as does the process of writing off everything in sight and various extraordinary charges, removing the burden of past costs from future earnings. You put all those things together, and American returns on equity are higher partly because the management is deliberately set out to paint the company as unusually efficient in its use of capital, meaning that it earns a high return on shareholders' equity. Think of how high we could drive our return on equity at Berkshire. I mean, we could make it almost any number you want if we just used enough leverage.
Yeah, we could run it with no equity.
We could run Berkshire with no equity. Yeah. And then people could say, gosh, these guys have finally learned how to manage the damn thing. It's not been an objective around here to reduce the equity to zero. But at other places, in order to make the reported return on equity good, they deliberately pound down the net worth as much as they can.
Yeah, the questioner may have seen, if you look at the S&P figures of the last 15 years, they report them both before special charges and after special charges. And there's been a very significant difference between those two figures. I mean, the American business likes to frequently write off things and say that doesn't count. And of course that takes the equity down, and it actually frequently benefits future earnings because you remove costs that would otherwise hit the income statement in future years.
The truth of the matter is you have part of this is shrewd and correct management of the company's financial structure and operations. And part of it can drift into gamesmanship.
Region 5.
Hi, Mr. Buffett. My name is Mallory Marshall. I am 11 years old, and I am from Kearney, Nebraska. I have 2 questions. First, my dad would like to know if you have any grandsons my age.
She wants to know if you have any grandsons her age.
How many shares of stock do you have? And I'll tell you the
Also, what investment advice do you have for young people of my generation?
Yeah, well, I've got a grandson fairly close to your age, and he probably would go for a younger woman anyway. So that, I will mention him to you. Mention you to him. No, if you're interested in financial matters, you've got to have something to work with. I mean, I was fortunate in that respect because my dad paid for my education. If he hadn't, I probably wouldn't have become educated if I had to pay for it myself. But so I was able to save $10,000 by the time I was 21, and that was a huge head start. If I hadn't been able to do that, and my first child came along when I was 22, so I mean, the family, it's much easier to save it in those teenage years if you're lucky enough to be in a family where you don't have, where your parents are taking care of your financial obligations. Every dollar then is worth making $10 or $20 later on. And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful. So I would say you're well on the way if at 11 you're even interested in coming to a meeting like this. And I would, if that interest is maintained, I would read financial publications. I would read whatever was of interest to me. I'd be curious about how the businesses around the town of Kearney operated. I would, to the extent that you can get people to talk to you, and people usually like to talk, learn about who's got good businesses in Kearney and why they're good businesses, and learn about the businesses that went out of business and why they went out of business, and just keep accumulating knowledge. That's one of the beauties of the business that Charlie and I are in, is that everything is cumulative. The stuff I learned when I was 20 is useful today. Not necessarily the same way and not necessarily every day, but it's useful. So you're building a database in your mind that is going to pay off over time. But you have to have a little money to work with. So there's nothing like getting a few dollars ahead, stay away from credit cards, and you can have a lot of fun if your mind goes along that track as you get older. Charlie?
Well, I'm glad to see somebody that has so early shown an interest in getting ahead. There's nothing wrong with getting ahead.
And actually, she may have the best idea about getting ahead by learning the name of my grandson.
Well, there I can give the young lady some advice. Before your feelings totally take over, you should look carefully at both parents and all four grandparents.
Write Charlie and let us know how it works out. Area 6.
I'm Jack Hurst, Philadelphia, Pennsylvania. 3 notes of thanks. First, for American Express for the terrific job they've done the last 3 times in scheduling reservations for me. The second is thanks for the care you take with your annual report. There is nothing more accessible than the statistics in that report, and the text is just absolutely marvelous. The third one is the care and feeding you give to troubled businesses, like World Book, which I'm glad it has survived, and Dexter Shoes. They're closing the plant in Milo, Maine, which is advantageous for the shareholders, but they gave the people enough time that because of the additional Jackson Labs expanded their hiring, and Fidelity brought 6,000 jobs into the area, so those people will have better chance for jobs than they had to if they were kicked out right away. The second point is a question about GEICO. You have a wonderful table in your annual report showing the number of policies issued and the policies in force at the end of each year for the last 7 or 8 years. In general, at the end of one year, the policies in force are equal to 95% of the policies in force at the beginning of the year, plus 60% of those that have been issued in the year. And that's been constant all up until this last year, when the amount in force at the end of 2000 is 24% of the policies issued in 2000 and 95% of those that were in force at the end of 1999. I'm curious if Mr. Nicely has asked, first, why is there such a large difference in lapse between the first year policies and the renewal policies, and why is there such a discontinuity in the year 2000?
Yeah, I'll answer the last one first about GEICO. The retention rate is affected overwhelmingly by 2 factors. One is the mix between the below standard business, the standard business, and the better business in terms of risk. In other words, we have, just making a calculation here, we have 75% or so of our business plus in the preferred category, but we have grown faster up till the last year or so, in the last 3 or 4 years before that, up till the last year, in the standard and the non-standard business. Those latter 2 categories have far greater lapse ratio or non-retention ratios or lapse ratios than the preferred business. They're 2 different businesses almost. So any change in the mix between preferred and the other 2 categories will change the aggregate retention ratio very substantially. The second thing is that the first year has a much higher lapse ratio than the second year of a policy, and in turn than the third, and so on. In other words, if you get the preferred business that's been with you 5 or more years, you have a very, very high retention ratio. In the last few years, we've added more new business than we were adding in the years before that. So we have had a higher percentage of new business, and we've had a higher percentage of non-preferred business, both of which would make the aggregate lapse ratio look higher, even though the lapse ratio, when categorized by class of business and age of business, really hadn't changed very much. Now, it's true, however, our retention ratio in the preferred business has fallen by a point or so. But that's That's the big difference. And now, unfortunately, our new business is not as strong, so you'll actually see but our preferred business is running stronger than our standard and non-standard. So you are seeing the mix go back in the other direction right now. I mean, currently that's going on. Through right to date this year, our preferred business is up in aggregate policyholders, and our standard and non-standard is down. So what you've deduced from those figures reflects changes in mix and age of business far more than it does retention ratio, although there was a minor change in the retention ratio. And that will be true, and maybe I should explain that better in the annual reports in the future. I touched on it once a year ago, but we can make that clearer in future reports. What you said about the American Express people, I echo. I mean, they have just done a fabulous job with people. We sort of turned the problem over to them of how people get here and where they stay and all of that, and we've had wonderful help from the local American Express office, and frankly, they've been so good we don't even think about it. We just refer people on to American Express, and I congratulate them for the job they've done. Thank you. Area 7, please.
I'm Chip Mahan from Minneapolis, Minnesota. Thanks again for this open format and your direct answers to our questions. You've talked a bit about the super cat class level of risk that you write. Could you share your thoughts about expanding the competitive advantage and the scale advantages at General Re, referring more to their traditional or historical franchise and the type of contracts they would write?
Yeah, General Re and General Re and Cologne are a very different operation than the historical reinsurance business of National Indemnity. National Indemnity had nothing like their distribution system, and I mean, they have a knowledge base for a whole different form of reinsurance than we could ever accumulate at National Indemnity. General Re did not, nor Cologne, did not retain as much risk as we're quite willing to retain, because their financial profile was different before they joined Berkshire. So it's an opportunity for us, for two reasons, to make more money in that respect than General Re might have made on its own. One is we can retain much bigger portions of what they would write in the first place, and which they've been writing over the years, but which they've laid off with other companies in what has the fancy name of retrocessionals. And the second point is that they have a distribution capacity that may well have the ability to deliver to us a lot of big risks that we might not otherwise see, and that in the past they might not otherwise have had a good outlet for. So there's really true, I hate the word, but there's really true synergy in General Re Cologne being married to Berkshire Hathaway, and you put your finger on really one point that has two aspects to it. And we haven't fully exploited that. We probably won't fully exploit it, 10 years from now. But it's very much in my mind and the minds of the managers at General Re and Cologne that we have expanded opportunities simply because Berkshire is willing to take on more risk than just about anybody in the world knowingly takes on, although we think some other people take on a lot more risk unknowingly. But in terms of writing a specific contract, we are both bigger and faster, I think, than anybody in the world. And in effect, we have some of the abilities that used to be associated with going to a Lloyd's of London. I mean, now, I don't know how true all that was over the years because I wasn't around there then, but we really can give an answer on something in an hour that other companies wouldn't know what to do with in a month, and that should be a plus for us in the world. Charlie?
Nothing to add.
Okay, Zone 8.
Okay. My name is Ethan Berg. I'm from Cambridge, Massachusetts, and I'd like to thank you for the education you've provided, particularly with the annual reports. I've got 3 brief questions. Years ago, you wrote to your friend Jory Orens that you were applying to Columbia's business school because they had a pretty good finance department and a couple of hotshots in Graham and Dodd. If you were considering graduate or business school today, with which individuals or professors would you want to study? Second question is a friend who wants to know your thoughts on the concrete, cement, and aggregates business. And the third question is from my wife. You mentioned earlier if someone were buying a parachute, they wouldn't buy based on lowest bid. We saw you tooling around in a car this week that were to be bought today could probably be bought at a relatively low bid. As someone interested in your health, she's wondering whether you've considered a newer automobile, possibly one with lots of airbags.
Oh. Actually, I picked out the car I have based on the fact that it had airbags on both sides. So that was a factor. It may have been the first car of its type ever made with airbags, but I think my car actually, it's both heavy and has airbags, and those are 2 primary factors in safety. I don't think I don't think a safer car is necessarily being made. It might be safer to drive around in a big heavy-duty truck or something, but I'm not ready for that. Incidentally, on a car, I look at that like anything else. It would take me probably a half a day to go through the exercise of buying a car and reading the owner's manual and all of that. And that's just a half a day I don't want to give up in my life for no benefit. If I could write a check in 30 seconds and be in the same position I'm in now with a newer car, I'd be glad to do it this afternoon. But I don't like to trade away when there's really no benefit to me at all. I'm totally happy with the car. I just don't want to trade away the amount of time I'd have to spend fooling around to get familiar with and get title to and do all the rest of the things. Pick one out, so a new car. But if there's a safer car made, I'll be driving in it. The aggregates business, concrete, all of that, those are businesses, and Charlie probably knows more about them than I do. We've looked at businesses like that. In fact, we've even owned a few shares at one time or another because it's an understandable business, and it's a business that, well, particularly if you get into concrete, cement, I mean, there have been periods of substantial overcapacity, particularly on a regional basis, but those are fundamental businesses, and at a price, for low-cost capacity and advantageously located raw materials and so on, we would do it. In fact, Charlie and I talked about one probably 10 or 15 years ago, quite a bit. And he's had a fair amount of familiarity with it. And what was the other one? I jotted it down here. Let's see.
He wanted to know what business school.
Business schools, yeah. Well, I would say this, that I think Bruce Greenwald's class at Columbia is very good. He gets in a lot of people that are practitioners, so there's a lot of practicality to the course, and I think Bruce is good. He's got a new book coming out that probably within the next 6 months or so that will deal with that. And then there also has been endowed at the University of Florida certain courses relating to value investing, and I think there's been one at the University of Missouri. So I would suggest you at least check out the curriculum at the University of Missouri and Columbia and Florida, and do a little comparison, and maybe check with a few recent graduates, as to what kind of experience they had. I think if you can find them, I think that's the best system for evaluating a place. But those 3 at least have courses that based on the catalog sound like they might be of interest to you. Charlie?
Yeah. A huge majority of the business school teaching on the field of investment of passive portfolios of securities is not what we believe, and not what Warren was taught years ago by Ben Graham. They're just little pockets of our attitude left. There's one at Stanford, Jack McDonald.
Yeah, sure.
And
that's graduate school.
It's graduate school. Yeah. And What's interesting about that is I think it's the most popular course in the whole Stanford Business School. They've got some kind of a bidding system. And yet I asked Jack how he felt, and he said he felt lonely. He's got the most popular course, but in the whole professoriate dealing with investment matters, the Jack McDonalds are a little clan of their own in a side pocket, so to speak. Now, they're right, and they can take whatever consolation they get from that. But mostly if you go to business school, you will learn a lot of things we don't believe.
Yeah, Jack, Bob Kirby comes in and works with Jack sometimes too, and you couldn't. And Bob has got a terrific mind in terms of investment. So that, I mean, there's no question about that. It's not the easiest school in the world to get into, and it is at the graduate level. But there are these occasional little anomalies, as they would say, in the teaching world. I mean, what you really want a course on investing to be is how to value a business. That's what the game is about. I mean, if you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business. And the rest of it is playing around maybe with numbers or, Greek symbols or something of the sort. But it doesn't do you any good. I mean, in the end, you have to decide, whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price. And that's what investing is. And I don't know any other kind of investing, basically to do. And that just isn't taught. And the reason it isn't taught is because there aren't teachers around, who know how to teach it. I mean, they don't know themselves. And since they don't know themselves, they teach something that says nobody knows anything, which is the efficient market theory. And if I didn't know how to do it, and if I ever teach physics, I'm going to come up with a theory that nobody knows anything, because it's the only way I can get through the day. But it's fascinating to me how the really great universities operate in this respect. If you get a sacred writ, I mean, you get in the finance department because you sign on, to whatever the present group thinks. And if they think the world is flat, you better think the world is flat too. And your students better answer that the world's flat when they get on exams. I would say investment finance teaching in this country is in general is kind of pathetic.
Well, I think the business schools do a pretty good job when it comes to accounting, or personnel management, or there are a whole lot of subjects I think they do quite well with. But they miss one enormous opportunity. If you learn to think intelligently about how to invest successfully in businesses, you'll become a much better business manager than you will if you aren't good at understanding what's required for successful investment. So they're missing a huge opportunity to improve the management profession by doing such a lousy job in teaching investment.
Yeah, Charlie and I see CEOs all the time who in a sense don't know how to think about the value of businesses they're acquiring, and then so they go out and hire investment bankers, and guess what? The investment banker tells them what to do. Tells them to do it because they get 20x if they do it and X if they don't do it. And guess how the advice comes out? So it's when a manager of a business feels helpless, which he won't say out loud, but inwardly feels helpless in the question of asset allocation, you've got a real problem. And they have not gone to business schools that have given them any real help, I think, in terms of learning how to think about valuation in businesses. And that's one of the reasons that we write and talk about it some, because there's a gap there. Okay.